35 times a billion, that's 100 billion. 35 over 100, 35% over, that's a sizable amount that you will have lost. So you find that the Kenyan government may opt to enter into such a futures or a forward contract that should the risk that they risk suffering, forex risk that they risk suffering, and the underlying cost or small initial investment, because there is a cost to entering into such an agreement, it should be really, really small and it should make sense. And that cost is usually called a margin or a premium. Okay, and so the contract must also underline, or the Kenyan government must also draw, or the Treasury Department at the CBK that is now drawing up the contracts to take the a billion USD investment or loan, must and outline the returns or the returns and the risk that are involved for and against taking such a contractual agreement with the IMF. Okay, so we also have other three other kinds of derivatives, not just the three that we know: options, forwards, and swaps. We also have what we call over-the-counter derivatives, and these are rather privately negotiated. Okay, let's say it can be a private negotiation or a private agreement between you and another party. Let's say you're trying to modify or customize your needs based on your, let's say, your business agreement with another party. It can be a business agreement, it can be a financial agreement or a financial transaction. Whatever kind of transaction it is, you can privately negotiate with the other party you're trying to. So that's basically from the word over the counter. Just let's say I'm with you here, we are trying to come into an agreement, let's say to buy some commodities. Okay, we are trying to, let's say, trade in maize. Okay, and the maize prices for a bag of 90 kg maize, Kenya, I don't know, is 3,000, but sometimes it climbs even up to a high of 5,000. Okay, sometimes even it comes down, and farmers really complain. So what we can, so let's say you are the farmer, you're trying to sell me the bags of maize. Okay, but you don't really can't afford to suffer the risk of the maize prices in Kenya going up or down. So we can, as a private party, or we can negotiate to tailor our. We can tailor it to suit our needs or our purpose. In this case, we are trying to exchange a bag of maize for some price. Okay, so it can also even include, even in financial transactions such as interest rate transactions, and so in that case we will also use things like swaps, forwards, and futures interest rates. So in that case, an interest rate swap. So let's say, oh, we are traders. Okay, we are trading, let's say, in USD and the euro. Okay, so between two parties, I and you, we can enter into a private agreement to negotiate a contract. Okay, to be able to, for example, swap. You also, let's say, you hold currencies and portfolio in more than one currency. Okay, you while me and you, we only transact with each other in terms of euros and USD, but yourself, you hold other currencies like the Japanese yen, the GBP, the Chinese yuan. Okay, and I also hold other currencies, the Canadian dollars and the Australian dollars. So we can come into a private agreement with you privately to be able to customize our needs, to be able to see, since we only trade between each other with the USD and the euro, why don't we, and maybe the euro has moved or is likely to move or fluctuate unfavorably against either of us. Let's try to bring in, let's, or customize our contract and involve, let's say, since the euro has depreciated against the USD, then why don't I sell to you, let's say, Australian dollars, something like that. Is so that's like an interest rate swap. So we are trying to, I mean, forex or currency swap. We're trying to swap another currency to suit our needs. So it's the flexibility in customizing it. That's why they are called over the counter. We can just over the counter, from the word over the counter, come and privately negotiate. But there are also some exchange rate derivatives that are traded at the exchange. For example, in some exchanges, the stock exchange, I'm not so sure, but I'm sure I read about an exchange in Chicago that resides in exchange. There are many exchanges, and like African countries mostly have just the one. Exactly, mercantile exchange. So at that mercantile exchange, yeah, Chicago Mercantile Exchange, you can trade in such some of these derivatives. Okay, okay, yeah. You go to some exchanges like in that case the Chicago Mercantile Exchange. You can even trade in some of these exchange rate derivatives, and like futures, options, things like that. You have the option, for example, to pay at a particular exchange rate, the right or but not the obligations, or you draw up a contract to come in a contract with the other party to be able to lock in an exchange rate at a particular price. And since they are traded at worldwide exchanges, so there is transparency obviously because it's an exchange rate contract or okay, an exchange rate derivative. So there is that transparency, and like privately negotiated. If we just come into a contract with you, which you can easily violate. And also, since there is transparency, so even the risk of you defaulting or reneging on our contract, they are more transparent because they are traded on a more transparent or higher level in the, for example, in the Chicago Mercantile Exchange. Mm. So yeah, we have seen now how sometimes we can customize, for example, the private contracts that we can or derivatives that we can come in with it between two parties to customize whatever needs that we may, or whatever transaction that we may be trying to come into. That is the OTC or the over the counter, and also uh, the others that offer transparency and are traded on a higher scale, like the exchange rate derivatives.
Thanks. I think it's your time.
Exactly.
Yeah.
Thank you so much. In fact, that was the end of that now introduction. So before we proceed to the next slide, we'll try to look at how these contracts came about and the history, the development, and so now before we can come into the in-depth analysis of each type of derivative, the option swaps, futures,
Okay.
and so on.
Thanks.